Hello and welcome to the second webinar in our three-part series on financials. My name is Kenda Freeman with Boss Bonds, and I am the education chair with Women in Surety. So today our presenter is Fariba Mehdian. She brings more than 25 years of accounting and financial management expertise, with a strong focus in construction and real estate and manufacturing. Today, she's going to be going over work in progress, also known as the WIP in construction. There will be time for questions during her presentation, as well as you can put them in the Q&A box in the Zoom presentation, and she'll be able to answer those throughout the presentation today. So if you have any questions, please don't hesitate to put them into the Q&A box down at the bottom of your screen. And she will get to those throughout the presentation as she has time for questions. There will also be a Q&A period at the end of the presentation that we'll have plenty of time for if you want to write down your questions and save them for the end. We hope you enjoy the presentation today. And Fariba,
Thank you. Thanks,
let you take it away.
Thank you so much. Thanks, everyone, for joining us. How many people do we have here?
There's currently 29.
29?
Yes.
That's awesome. Okay. So like Kenda said, my name is Fariba Mehdian. I'm a CPA and also certified in construction financial management. I've been working with contractors over 25 years in public accounting, as an outside CPA, and in the last few years as the fractional CFO. So I, do consulting and help my clients to have basically better financial statements so that they can have better bonding. And you guys are happier with them, as also, help them with their banking and many insurance, risk management, and a lot of other issues that the contractors encounter. Today, we are concentrating and focusing on work in progress in construction, because this is really how we calculate revenues and recognize revenue in construction and commercial contracts. Some residential contracts are different, but we basically concentrate on commercial contracts. So we are going to have an introduction and what the WIP is about, some of the definitions, and the lingo that is used by accountants, by sureties, by bankers, and also a simple calculation of a sample project, how we calculate the work in progress, and what is the impact on our financial statement, why is it important. And of course, at the end, there is opportunity to answer any questions you guys have. And you also do, like Kenda said, you can write your questions in Q&A during or after at the end of the session. The session is scheduled for an hour and a half. I don't believe the presentation is going to take that long. So I think there's going to be plenty of time at the end if there are questions. So as I mentioned, the work in progress, really, the reason we do that is how to recognize revenue in construction industry. And basically, a few years ago, the Financial Accounting Standard Board, which is basically the body of setting up standards for different industries, and basically accounting standard and generally accepted accounting principles, they came up with a standard which is called ASC 606. And a lot of you who see formal financial statements from compiled, reviewed, or audited, if you look in the footnotes, and when the footnote talks about revenue recognition, they refer to this standard ASC 606. There's not really, I don't think you guys need to know the number or anything, but it's really what's basically telling us how to do our revenue recognition. So to comply with this standard, we basically have to first recognize what our contract is. Do we have a valid agreement with the customer? And then identify, they call it performance obligation. And what it really means, as the contractor, what is the contractor obligated to perform? What is the basically product that they have to at the end deliver? Then when we know if we have a contract and what is the scope of that contract or the performance obligation of the contract, then we need to know what the transaction price is. Obviously, in fixed price contracts, it's easy. It's a number that's there, and we know how much the contract amount is. But there are many different ways of doing construction contracts. There are unit price contracts, or other types of contracts. So, however, for the work in progress calculation, even if there is not exactly a number that we know, we have to kind of come up with a transaction value and do a really good estimate for that contract value. Then sometimes a contract could have more than one performance obligation. Like as the example I put here, for example, the contractor is building a warehouse. And also, after the warehouse is ready, there may be a service maintenance contract to maintain that for 2-3 years, 1 year, depends. So if these two are all part of the same contract, obviously the maintenance part will start at the very end. So we try to allocate that total $5 million value in this contract and estimate how much is the cost of building the warehouse, and then what is the cost of maintaining it for however many periods we are required to maintain it. So this is how we allocate the price. A lot of contracts have only one performance obligation, so we don't have to worry about this. And then after we have recognized all these items, then we basically start performing the project. And as we perform the project and we go through the progression of the project, we calculate revenues by calculating percentage of completion. So I'm going to go over some of the work in progress definitions. Basically, work in progress schedule is the schedule that you will see in many construction financial statements. It's like Candace said, we call it the WIP, so everybody knows it as the WIP. Normally, the financial statements have two different job schedules towards the end. One is the job schedule for all the jobs that finished and completed in that fiscal year. And then the next job schedule is the WIP schedule. I'll have a sample towards the end of this. I mean, when we go further, I'll show you. And then what we are doing in the WIP, we are basically calculating the percentage of completion, which is how the construction contractors actually comply with that ASC 606 standard. And it's in compliance with generally accepted accounting principles. The other key definitions, so we talked about WIP. PCM, I just want you to know these abbreviations in case you hear them and then you know what they are. They're not really anything that we don't know. There's sometimes, the lingo that is good to know the abbreviation. PCM is percentage of completion method. And that's the method that generally accepted accounting principles requires us to calculate, the revenues for financial statement. Please remember that a lot of tax return of construction companies may not be on PCM. So there you will see one number of revenues on the tax return that could be very different from what's on the financial statement. And that could be many different reasons for it. The smaller construction companies are allowed, or the smaller business in general, are allowed to be on cash basis for tax return. And I believe it's, the number changes all the time. I don't remember, but I think it was gross receipt for each year about like 30 millions. I believe like the average gross receipts up to 30 million, you can still be on cash method for tax only, not financial statement. Then the other verbiage that we have in the percentage of completion environment is overbillings and underbillings. In the last few years after ASC 606 went into effect, you don't see overbilling, underbilling on the balance sheets anymore. They use contract liability in lieu of overbillings on the balance sheet and contract assets instead of underbillings. In fact, contract asset also includes retention receivable. So they combine underbillings and retention receivable on the balance sheet and call it contract asset. And contract liability could include some retention payable, but I'm not going to get into much into retention in this presentation, but that's basically what it is. Then, okay, so what information do we need? The minimum amount of information that we need to be able to calculate the work in progress and the percentage of completion, and eventually the revenue recognized on one project. So if you look at this building that we're looking at, when we are bidding for this project, obviously, there are blueprints and the contractor gets all the information from the owner of the project. Let's say it's a general contractor who's building a hotel for one of the developers. So they agree on the contract value, they bid for the job, obviously, the job is awarded. They have a budget. They have a budget in their own system to complete this building. That budget, we also call it estimated contract cost. It's, at least at the beginning, it's the same. The estimated cost of contracts originally comes from the budget that we had when we were bidding for that job, the budget that we think we're going to finish that project. So we have the contract value. We know how much it's going to cost us to start and complete the project. Then at the end of each period that we want to calculate our revenues on that building after the job has started, then we have to look and see what is our actual cost for that time period and how much have we billed the owner of the job. So these are the four minimum items we need: contract value, total estimated cost, cost incurred at the end, at the date that we are calculating the revenues, and the billings that we have submitted. In some of the other industries, for example, say that, in the residential and some other industries, that percentage of completion may not be the way we calculate revenue. Obviously, our billings and revenue could be the same thing. What we billed is what we earned, and there is no over under. But in the percentage of completion method, that's not the case. Many times billings is not necessarily the same as our revenues, and I'll show you why that may be. It would be wonderful if our billings was always, the revenue we earned, there would be no disputes, the owners accepts our bills, the contractors' bills as it's sent, but that's 99% of time is not the case. So the way we calculate the work in progress, and obviously as it results to our revenue on that project, it's typically cost to cost method. And by that, I mean, when we, at the end of the year or end of the month or any time that we want to see how much revenue we have earned on our contract, we have to see how much our total actual cost was. When we know what actual cost is, it's on our accounting system. If we have a good accounting system, all the payroll, all the material, whether we paid for it or not, we received the bills from our subcontractors, from our suppliers. So it may be still sitting as a payable, but it's our cost that we have to eventually pay for it. So we have to know at the end of that period, what was our total cost? And then obviously we know our total estimated cost because that's the budget, and we had to come up with that before we even bid for a job. When we divide our actual cost by that total estimated cost, that percentage that we get, that is a percentage of completion. So even if we have not built this job for a dime yet, we still have earned revenue. So incurring cost results in revenues in construction. The only time that incurring cost will not result in revenue if it's wasted cost. Like we send people to a job site and they do nothing, but we still have to pay them. Yes, mathematically, we may think we have earned revenue, but in reality, are we going to be able to bill for that? No. So actual cost, actual production cost, whether it's material that is the right material, it's not the wrong pipes, because I've seen it happen, like people order the wrong pipe, or the wrong pipe gets delivered, or the architect made a mistake and it has nothing to do with the contractor. In that case, obviously, hopefully contractor can go back and get a change order. But when we say cost incurred, it has to be cost that resulted into building, into producing. So when we divide that by our total estimated cost, that gives us the percentage. That percentage is now used to calculate revenues. We multiply that percentage by our contract price. And that gives us the revenue for that period of time. Whether we can actually bill for that or not, it depends on what we calculate as the percentage of completion. Hopefully the owner agrees with that. Hopefully the inspector of the owner goes and doesn't say, oh no, this is not that much complete, or this items are not done, or they have to be removed or redone, which happens a lot. So we also, the contractor also really need to use their historical data. They should know what type of work is a better type of work for them. They normally should know the logistics and locations where the owners, who is harder to work with, who is easier to work with, relationships that they have with the other subcontractors, how hard is it to get change orders approved. A lot of these factors really make a difference in how our revenue recognized is accurate or not. Mathematically, we come up with a number, but really in reality, sometimes that number is very far from reality, because we are hoping our budget was a good budget. We're hoping that our total estimated cost, in fact, is going to be what the contract is going to end up with. Like in this environment with all the tariffs and, the tariffs and the materials, and a lot of projects may not have that escalation price clause in it. Then what happens, obviously, our total estimated cost is going to have to be adjusted. So we're going to have to show less profit and make less money on the contracts, even though the contracts, reality is that we are going to incur more costs, but that doesn't mean that the owner is going to take responsibility for the additional cost. Any questions? Do we have any questions, Heather?
I don't see any.
No? Okay.
Nope.
All right. All right. So again, going just through the math, the mechanics of calculating, like I said, cost to cost is the way we come up with percentage of completion calculation. And then multiply that percentage by contract value, and then compare our revenues to the billings on that contract. So in reality, it's really, the formulas are already written. You don't have to even do that by hand. The schedules that bonding and sureties use, they all have the schedules. The contractor themselves that have the schedules. So the math part of it is not hard. This is just an example of, say that, we started a contract and this is the first month that we are billing the contract. Our contract value is $1 million. We're hoping to make, or estimating, not hoping, we're estimating to make 20% on this project. At the end of December, we have $400,000 on actual cost. This includes our payroll taxes, related insurance, materials, suppliers. If we have subcontracts, we make sure they received all the invoices from their subcontracts, and everything is recorded in their accounting system. However, the project manager, they may have even submitted a bill at a higher price, but the owner only approved $350,000. Okay. When we go through the calculation, so $400,000 actual cost divided by our total estimated cost. The job is 50% complete. So think about it. Say that we are building an office building with 4 rooms. Make it simple. So in reality, at this point of time, if we do finish one room and go to the next, we should have finished, and say that all the rooms are equal. We should have fully finished 2 of these rooms, right? We're saying the job is 50% complete. 4 rooms need to be built. 2 should have been built. So we should have been able to bill for 50% of this contract. If we multiply the 50% by the contract value, our revenue earned is $500,000. So why didn't we bill $500,000? Why did we bill only for $350,000? Why did the owner of the project, even if we tried to bill for $500,000, they didn't approve it? Is it because the inspector went to the job site, and even though our math is saying the job is 50%, were the two rooms that needed to have been completed, were they actually complete? What happened? Did our project manager just miss that they're behind? Because what happens, contractors normally bill around 20th of the month, so they have to project their costs through the end of that month, even though it hasn't incurred yet. So that could be one reason that a construction company is underbilled, because they thought they didn't realize the job was going to be 50% complete. That's totally fine. They're going to bill next month. Fine in the sense that at least they're not losing. It's not fine from cash flow standpoint, because obviously they're going to be out of cash for a while until they get paid or they bill the next following month. So again, where the mechanics and math shows 50%, we weren't able to bill 50% because we billed only 350. And if we compare our revenues to billings, we are $150,000 underbilled. Okay. Underbillings or contract asset, like it's called, it's an asset. So assets should be good, right? Assets, it's good to have assets on the balance sheet, but only if they're really going to turn into good assets. Can we actually bill it? Can we receive it? So this is going to be our income. If we have only this job and we have nothing else going on and we have no other unrelated cost, this is going to be our income statement. Revenues 500,000, job cost 400,000. The gross profit on this project is $100,000. So income statement simple. Simple, right? Then our balance sheet, we billed for $350,000. So our accounts receivable is $350,000. And our underbillings, or the other asset on the balance sheet, is going to be $150,000. So the two together make up that revenue, that $500,000 revenue. For those who looked at these slides before, this number, accounts receivable number, was not correct. Please pay it. I mean, I missed that. It was 500,000 by mistake. I was reviewing it and corrected it after. So please correct it in your slides. So this is when the job is underbilled. And this is how the schedule going to look like. So we have $1 million of total revenues or contract amount, estimated cost of $800,000, and the exact same numbers that we just talked about. And the underbillings, as you see, is $150,000. And this section, the fifth block of the schedule is the income statement for that period of time, whether it's a 1 month period or it's a 1 year period. Okay. All right. Then we go to the next example. Everything is the same except for the billings. So on this one, same contract, same estimated cost, same cost, actual cost. The only difference is we billed $600,000. So our income doesn't change. Our revenue earned doesn't change. Our income in the percentage of completion environment doesn't change. We're still 50% complete. We still have earned $500,000. The only difference is now, when I compare our earned revenues to our total billings, we are overbilled, $100,000 overbilled. Overbillings, a contract liability. It's a liability. Why is it better than an asset? Why is a liability better than an asset in this case? There are many reasons for it. First of all, if the $600,000, when the $600,000 is paid, we have a lot more cash to work with for working capital. So we don't have to finance this project for the owner of this job. We don't have to go to the bank and borrow so that we can pay our weekly payroll, because basically we are already ahead in billings, and hopefully we get paid soon, and it really helps with our cash flow. When our next presentation, when Heather is presenting and she's going to go over cash and cash flow, this is going to be really something that contractors concentrate on, and if they are really doing a good job, they can be overbilled versus underbilled. Even though it doesn't affect our our income statement, it really affects our balance sheet and cash flow. Okay, so as you can see, our income statement is the same, at least in this time. Okay, because we are earning $500,000 revenue earned calculating, the cost is the same, gross profit. What is different is our balance sheet. So here in this balance sheet, our receivables are $600,000 versus $350,000 in the scenario before, in the previous example. As you can see, $250,000 difference in cash that will come in to the bank or to the company, sorry. And then this $100,000 is a liability. So the net of the two, this is actually the 100,000 is going against this 600,000 as far as balance sheet being in balance with the income statement. So everything this is a much better scenario for us than having an underbilling, because with underbillings, the fact that can we bill in the future that's really the question to be asked. So that's why it was really hard for me at the very, very beginning of my career to understand why this liability is better than an asset. But basically, if an asset is just because our estimate is not a good estimate, then eventually it's not going to be a good asset. And this is the same project. The only difference is this billings, everything else is the same. But therefore, we are overbilled in this schedule. So when you look at the financial statements and the work in progress, and obviously they have a lot more jobs than just one job. I mean, the subcontractors have many jobs. General contractors have a handful of jobs, especially that many general contractors have much larger contracts. And so you want to not only look at each project and why it's underbilled or overbilled, you also want to look at the total underbilling and overbilling and making sure that we are not like way underbilled in total, because that gets really scary because it affects the cash flow. It's a very big possibility that some of those underbillings will not materialize and will not going to be able to bill. Sometimes underbillings also happens due to change orders. So normally we don't want to include change orders in the contract value unless we are really certain that it's going to be approved. There's in accounting, we say more likely than not. So it's actually more likely than not that we can get this change order approved. And we accountants, we kind of interpret it to 75, 80%. So if I'm 80% sure that this contract, I can get another $150,000 of change order, then in this calculation, I may actually change this million to $1,150,000. It's really good to be more conservative as the job is being worked on. And then if, at the end, when the job is fully done, then we can pick up the rest of the profit. But being too aggressive in estimates and then having to show a loss at the end of the project, it's not really a favorable situation. So So what are the thoughts? What are the conclusions after, again, when we do this? We really want to be doing a job fate analysis. And what does that mean? So if you think about a 12-month calendar year or fiscal year, doesn't matter, it's always 12 months in any year. And you do your work in progress, the contractor does a work in progress report at the end of each month. If our budget is not gonna stay as it was at the beginning, and if we're gonna finish the job at much higher cost that we had estimated, what's going to happen, it's at the beginning, in the beginning months, we are gonna recognize more profit than we should have, because we thought the job was more complete just because of the math. And if we don't actually, okay, we do the math, but we have to also compare it to the reality of the project. If your accountants, the controller does the calculation, and they're not the ones who are in the field, but there should be a lot of communication between the finance and accounting team and the people who are managing the projects, the project managers, whoever who, like superintendents, whoever that knows the jobs and understands that we have a good budget, our total estimated cost is good. So, and if it's not, if we come across unforeseen circumstances, if things that it was missed in the estimate. I had years and years ago, we had a client that I think they were bidding for a very, large building. I think it was many, many stories. And for some reason, the estimate, they missed a whole floor. And I think it was due to the, sometimes they don't have the 13th floor because they don't want to, I don't know, for some reason, people don't like the number 13. So if that kind of missing in the estimate happens, can you imagine how your total, that's the responsibility of the contractor. That's not the responsibility of the owner. When the owner gives you all the blueprints or the architects, but you miss a big thing, then your beginning budget, your initial budget is not going to be a good budget. So if you keep that initial budget as your number for calculating your completion, percentage of completion, you're going to show the job a lot more complete as you go. And then all of a sudden, from cost standpoint, you may be 100% complete, but the job's not done yet. Then you go and a lot of other things haven't taken place yet. That's why it's really important to revise your budget month to month. And a huge red flag is just be underbilled on a contract month after month and not be able to bill, because again, our math says one thing, but the field says something else. And the owners, the inspectors, they don't allow us to bill because they don't agree. They don't agree that we are done at the percentage that we think we are done. So this profit fade analysis, I'm basically looking at overbillings, looking at our budget, looking at the scope of the project. Like sometimes scope of the project changes. The owners, think about you. Like if say that you want to remodel your kitchen, you bring a contractor to your house, and then little by little, then you want to also take down a wall and you want to add something else. And all of a sudden, you have a lot more work that was originally in the scope. So if the contractor doesn't bill you for more money for what you added, they're going to be out of pocket, obviously. I mean, if you put that into a much, larger perspective, you can see that if a job spans over several periods of time, some jobs take a few years. So if you don't adjust the budget as you go, and sometimes hopefully for the better, I'm not saying it's always going the negative way. If you are a really good estimates, you can maybe even finish better on what you thought it was going to be. So it's important to be consistent. From what I understand, the sureties and they really don't like to see these fluctuations on the job, because then they're going to think you don't know what you're doing. Your estimators don't know. They're not doing a good job. Then they don't know what they're doing. So why the accountants in the company calculate the percentages based on the information given to them? If the information is not accurate, then that calculation is really not accurate. Again, the biggest red flag that we've seen over the years are underbillings on jobs, that we have to always question it and make sure that if they say, no, I'm going to be able to bill it, go to the following month. And yes, they're going to have billings following month, but are they going to also cover what they hadn't billed, the costs that they hadn't billed for in the previous period? So in order to basically prevent this additional losses, we really have to capitalize on efficiencies, making sure that our field efficient. They have everything they need, so they don't have to go buy things in the middle of the job and the work. I had a very small client that every day people had to run to Home Depot to, I don't know, buy something, even if something small. That takes time. Creates a lot of, lack of efficiency. The other thing that's really, really important from the subcontractors' standpoint, from the GCs, to watch change orders, to make sure that you are constantly talking to the owner of the job, the project manager on the other side that you're dealing with. If you don't manage, if change orders are not managed, they are going to actually impact the jobs, really, the company in general, negatively. Unfortunately, a lot of contracts start at one price and they really, really change during. And change order management is extremely important. And as we are able to get approval on our change orders, we also change our contract price. And of course, we have to also revise our estimates, the budget, because if the scope is changing, if things are added, it's not just adding to the contract value. It's obviously also adding to our cost of the project. For general contractors that get a lot of change orders from their subcontractors, they also have to make sure that they get approval from the owners. So it's two sides. They have to approve the change orders for their subs. They also have to get approval for their own contract. It's really important to have really good relationship with your subs, with your owners, in like anywhere, right? Relationships matter. And then estimates, bad estimates could put a company at a huge loss, really dangerous the financial situation. Estimators need to be trained, need to know what they're doing. So at the end, we need to understand what's driving the over-under billings, what is affecting and creating profit fade, and be able to analyze them period to period. And as you've always heard, cash is king. So in order to have enough cash for working capital, to be able to pay people every week, and to be able to basically meet all your liability obligations, it's really, really important that you manage your jobs profitably, obviously. And of course, be able to get bonding, because if you show losses month after month, year after year, then you know a whole lot better than me that it's going to be very hard to get a bid bond or a performance bond or any kind of bond. So I guess we finished a whole lot faster than scheduled. So there is time for questions and answers if there are any.
I don't see any in there right now, but for any attendees who have questions, there is the Q&A feature down at the bottom of the Zoom player that you can click on and ask any questions that you have of Fariba.
No questions?
It looks like there's no questions.
Right. There are no questions. I do want to thank everybody for coming and taking this time out of your day to attend this. Oh, go ahead.
A couple questions.
Did you say there are any
Oh
questions?
yeah, there one of the participants wants to know, is there a formula to calculate job fade?
The formula to calculate job fade is if you basically put the revenue, gross profit earned on each job month to month. So if you do a monthly WIP and then put, like, say you do it at the end of December and then you do it next January. When you change the estimates, the gross profit in the following month is going to go up and down, up or down. And then basically that's how we compare the revenues earned and the profit earned, and also how much more cost we have. So there is no right formula in that sense. It's just comparing and doing a very simple percentage. Like if we had 10% of more cost than second month, but our revenue was 2%, it means that we really lost money in that second month. I mean, Heather, you want to elaborate on that?
Yeah, no, that would be the same, the same approach I would take, is that profit fade is really something that you look at over time. So, in a traditional WIP, there's like a current year column that if you see those numbers being negative, then that means that the job has faded. But in terms of predicting what kind of job or which job is going to fade, like in advance before a job has completed or has made its way all the way through, like Fariba said, comparing, one period to the next is going to show you when something has faded. But like in here, if you're looking at that for the 1 month ended over here, the revenues and costs all the way to the right, if anything ever shows up negative over there, then that is like a surefire indicator that something has faded, because it was estimated at a higher margin last year and this year it's a lot lower.
Yes, even though this job still may not,
Right.
in total may not show a loss, it could show a loss for that one period because we had overstated our revenues and our profits.
Awesome. It looks like that is it for questions. There's a couple thank yous. Of course, thank you, Fariba, for sharing your experience and time with us.
Well, thanks everyone for joining us. And if you have our contact information, Heather and I are the are co-treasurers of the Women in Surety West Coast, and any of you have any questions, we'll be more than happy to answer.
Absolutely, and the information is also on the Women in Surety website for the West Coast, as well as the sign up for our third and final webinar in this series that we will be doing on October 30th for balance sheets and red flags, what every surety professional should know. So that one will be hosted, or excuse me, will be our host for that one will be Heather. So that will be October 30th from 1 to 2:30. Registration is open and available for that on our website for West Coast Women in Surety. So please be sure to sign up for that one and join us on, again, October 30th for that one. And that'll tie everything together for financials.
Well, thank you so much, Kendra. Thanks, Heather, for
Yes, of course.
facilitating this webinar.
Yeah, and thanks everyone. And there should be a brief survey at the end when we close this webinar. If you guys don't mind filling that survey out, it really helps us to identify what kind of education or webinars that we can provide to the membership. So we want to make sure that we're giving you the best value for your membership. And one of the ways we can do that is by hearing exactly from you guys how we can help.
Absolutely.
Awesome. Thanks, everybody.
Thank
Thanks,
you.
guys. Have a great day.
Bye.